Imagine this for a second. Somewhere behind the scenes, someone quietly opens a massive dollar fire hose. Banks load up on U.S. Treasuries, tap a secret credit line, and billions of new dollars drip into the system. But there's no press conference, no QE is back headline, nothing. If you can spot that hidden flow before everyone else, you can see the next big crypto rally coming early. That's what this video is about. Arthur Hayes' stealth QE theory, how the Fed might be injecting liquidity without calling it QE, and why that matters for Bitcoin and altcoins. If you stay with me until the end, you'll know exactly which signals to watch, so you're not the last one to figure it out. So don't skip around on this one, let it run. Let's start with what's happening in the market right now. Recently, we've had a weird mix of signals. Bitcoin has been chopping around key levels. ETF flows swing from huge outflows to weak inflows, and sentiment feels fragile. Yet, in the middle of all that, some mid-cap altcoins suddenly explode 50, 60, even 70%. That's not random. It tells us liquidity is already moving, but it's being very selective. Big players are asking one question. Where is the structural, long-term flow of money coming from? Arthur Hayes thinks the answer is hiding deep inside the plumbing of the dollar system. If you don't know him, Hayes is the co-founder of BitMEX and one of the most widely read macro voices in crypto. In a long essay, he claims the Federal Reserve has built a way to quietly pump liquidity into markets while still publicly talking about tightening and fighting inflation. The key piece is something called the Standing Repo Facility, or SRF. Hayes calls the effect of using it at scale stealth QE. To understand why, let's quickly rewind to classic QE. In 2008 and during the pandemic, the Fed openly bought trillions of dollars worth of bonds. Everyone saw the balance sheet explode. It was official, public, and politically toxic. Today, the word QE is almost untouchable. The Fed can't say we're serious about inflation and at the same time announce a big new money printing program. So, according to Hayes, they needed a way to provide liquidity without calling it QE. That's where the SRF comes in. Repo markets are normally a way for banks to get short-term funding. They hand over treasuries as collateral and borrow cash for a few days. With the Standing Repo Facility, the Fed turns that into something close to a permanent, always-open credit line. A bank takes a pile of U.S. government debt, gives it to the Fed, and gets dollars in return. Later, they reverse the trade and take the bonds back. On paper, it's just a repo. In practice, if that window is deep and always available, it acts like a bottomless dollar tap. No one has to call it QE. There's no big headline. But the result is the same direction. More dollars in the system and more support for the Treasury market. Hayes' argument is simple. Whether or not you call it QE doesn't matter. If banks can continuously turn treasuries into fresh dollars through the SRF, that's real liquidity. Why does he think this is becoming critical now? Because the U.S. is running a huge structural budget deficit, around $2 trillion a year. To finance that, the government has to issue an enormous amount of treasuries. At the same time, demand has changed. After events like the freezing of Russia's reserves, some foreign central banks are less excited about holding U.S. debt. Domestic savings are low. U.S. banks can't absorb unlimited new bonds. That leaves leveraged players and the repo market to pick up the slack. But they can't do it without support. If funding dries up, treasury auctions struggle, yields spike, and the entire borrowing machine gets unstable. So the Fed, in Hayes' view, quietly steps in with the SRF, giving dealers a safe place to turn those treasuries into cash whenever they need it. That keeps the bond market functioning and injects liquidity at the same time. Again, no one calls it QE, but the effect rhymes with QE. There's also the Treasury General Account, basically the government's checking account. Because of political drama and shutdowns, extra cash has been stuck there instead of flowing into the real economy. When that money finally gets spent, it comes back out into markets. If that lines up with heavier SRF usage, you can get a sudden mini wave of liquidity that catches risk assets by surprise. So what does any of this have to do with crypto? Historically, Every major expansion of dollar liquidity has pushed investors out the risk curve. Once the plumbing is full of cash, people start hunting for yield and upside. Bitcoin, with its fixed supply and digital gold narrative, tends to be one of the first big beneficiaries. And today we're already seeing some early signs. Certain sectors, Layer 2s, infrastructure, and privacy plays, are moving much harder than the rest of the market. On-chain data shows large players accumulating BTC while smaller traders sell into fear. ETF flows, after record outflows, are slowly turning back toward net inflows. None of this proves stealth QE is fully underway, but it lines up with the idea that big money is quietly positioning while retail argues about the latest red candle. Of course, there are real risks. Hayes doesn't know the exact date this becomes explosive, and neither does anyone else. SRF numbers are public, but nobody can say, at this exact level, Bitcoin moons. And the global liquidity cycle is not only about the Fed. China's slowdown, Europe's policy choices, inflation surprises, and geopolitical shocks can all change the picture. If inflation comes back hard, the Fed might have to tighten again, cool liquidity, and delay any big crypto rally. That's why you should treat this as one framework, not a guarantee. So what can you actually do with this? Focus on a few key signals. If daily SRF usage starts to climb and stay elevated, that suggests the hidden tap is being opened wider. If the TGA balance falls quickly while Treasury issuance stays high, that tells you the government is pushing cash back into the economy. If that lines up with consistent positive ETF flows and on-chain accumulation by whales, you've got several liquidity indicators pointing the same way. That's when the idea of stealth QE stops being a Twitter meme and starts looking like an actual driver of capital flows. To wrap this up, Arthur Hayes' stealth QE theory gives us a powerful lens on what might be happening deep inside the dollar system. It's possible the Fed is quietly supporting the Treasury market and injecting liquidity through the Standing Repo Facility without ever saying the words quantitative easing. If that's true, the money doesn't just sit there. It eventually leaks into risk assets, stocks, credit, and, yes, crypto. We can't timestamp the exact moment when that turns into a full-blown rally. But by watching SRF usage, the TGA, ETF flows, and on-chain behavior, you can at least see the direction of the tide instead of guessing from one candle. If this helped you see the bigger picture, hit like, subscribe, and let me know in the comments. Do you think the Fed is already running a form of stealth QE, or is this just an overhyped story? Thanks for watching, and I'll see you in the next one.